Hi, I'm David Stein of Money for the Rest of Us, and this is the channel on money, investing in the economy, and today we're looking at farmland investing. How I made 300%, $300,000 investing in farmland, and what is it that drives those type of returns? Not everyone can get that. I certainly couldn't get that. There was an element of luck involved, but we'll take a look at farmland investing and how you can participate in this very unique asset class. Let's go ahead and get started by first looking at the drivers of farmland returns. There are two drivers, primary drivers of farmland. The crop income, what you make selling the crop, or if you own the land and you lease it to a farmer, it's the income that the farmer will pay you for being able to use that land, and that income is based on what the farmer thinks they can get with the crops that they grow each year. The other major component of farmland returns is the land appreciation. And that was by far the biggest component as to why I made so much money investing in farmland. Now, the reality is what drives those farmland prices are the price of commodities, agriculture commodities, but also other types of commodities, because we find that farmland and farm crops tend to move in tandem with other commodities like gold, oil, etc. The other driver of farmland returns are interest rates. Just like with regular real estate, as interest rates go down, that tends to push up the value of land, including farmland. Now, commodities tend to move in what are known as supercycles, and these can be anywhere from 20 to 70 years. And we'll look at the returns of farmland and we'll see how the best returns came during peaks of commodities. These commodity prices tend to be global, so it isn't just one particular country. And so that has been a huge influence on farmland returns. Now, here's a chart by Acre Trader, and I believe they pulled it from the NCREIF Farmland Index. This chart frustrates me a little bit because it only goes through 2017. Now, they're showing returns of about 11% or more for farmland, but going back to 1991. And that's a really particular year because that was the low when it came to farmland prices. Now, what you can see there are two periods where farmland did particularly well, around 2008 and again around 2012. That's when the best returns were for farmland. We can see that those same returns were the same time that commodities did very well. This is the Bloomberg Commodity Index, the price index. Look how it peaked in 2008 and again in 2012, just like these farmland returns did as reported by Acre Trader with the NCREIF Farmland Index. Now, let's take a little closer look at these farmland returns. And this is just the land itself. It doesn't include income. We saw that Acre Trader chart that started in 1991. According to the USDA, the average per acre price for farmland in 1991 was $1,200, down from $1,800, which was the previous high, about a 33% decline. Then farmland boomed as the commodity prices boomed and hit $2,300 in 2006, and then again by 2014, over $4,000. Then they held steady. We went in sort of a commodities bear market. Commodities didn't do as well. And then just in the last year, as commodities have rebounded, agriculture commodities have boomed 45% in the past year. And that has led to an 8% increase in farmland, according to the USDA. Now, if we just take those returns, since 1980, farmland has only appreciated about 2.2% per year. And since 1991, the average acre has appreciated at 4.4%. Now, that's just the price appreciation. As a farmland investor, you get the income from the crops, which right now averages around 4 to 5%. So if farmland returned 2%, the land itself, or 2 to 4%, and you got 4 to 5% for the actual crop, either through rent, from farmers or actually from selling the crop, the overall return would be kind of in that 6 to 8% range, which in my mind is a reasonable expectation for farmland returns. Not 300% like I saw. Now, if we annualize my 300%, we'll look at how I got that. It's about a 30% appreciation, but it didn't have anything to do with the crop. It all came down to the land and where we bought that farmland. Now, let's go ahead and take a look at some other elements of farmland. One of the things that's often said is, well, they're not making more land, and there's less and less land being farmed, and somehow that is going to increase the returns for investing in farmland. And it's just not true. Let's look at some additional data from the USDA. This shows that the number of farms has been dropping in the US since the 1800s, and the amount of farmland has been dropping. The average farm size has gotten bigger, but there's a reason why there are less farms and less farmlands, and that's in this chart. This shows the total output, the total production of food of US farms going back to the mid-1940s. It also shows how much was input in that, how much was put in seed, how much land was involved, how much labor. And you can see it's flatlined. It hasn't grown. Yet the output is so much more due to greater productivity. Farmers are better at farming. The yields on the crops are higher, and as a result, we don't need as much farmland to produce ample crops. Even so many crops that they have to export a significant amount of that output. And so we can't say, well, there's less land, and so farmland's a great investment. Again, it's going to come down to commodity prices and interest rates and higher and better use for the particular parcel that you might have bought. Perhaps it could be sold for recreational property as opposed to it being just used primarily for farmland. Now, we can look at farm income. Again, this is the USDA. Farm income has been flat over the past decade, and the net income has been flat. So this is not necessarily a high returning asset class. Again, 6 to 8% return is reasonable, but it goes through some booms and busts that are tied to commodity prices, as we saw. Now let's go ahead and take a look at my farmland investment and how that came to play. Back in 2011, Laprelle and I bought 80 acres. It had a house, it had barns, it had all these outbuildings, a big shop. We're not farmers, but it was really inexpensive. And more importantly, it was in Teton Valley, Idaho. So we had a tremendous view of the Teton mountain range. It was a beautiful place. We bought that and then ultimately split it into two 40-acre parcels. The one parcel was just bare land, and it was farmed. The other parcel had the outbuildings, and it was farmed some, but we're just going to focus on the 40 acres that was just plain farmland. We bought that for about $100,000 in 2011, about $2,500 an acre. The yield, the rent we got on it was very small, about $800. This is arid ground. And so were no water rights with the particular farm. There was no irrigation. It's just whatever came from the sky. And the farmer kind of went through the financials with me, and we agreed on $800 an acre, and he would keep the weeds down. So this was not an income-oriented asset class, nowhere near the 4 to 5% yield that we talked about for a typical farmland. But we sold it this year for over $400,000. The reason why? Because people wanted to move to the valley and experience that great view. It had nothing to do with the actual value of the land as farm ground. It was strictly based on the view and the quiet setting. So we earned $300,000, about 300% before taxes. But that's hard to do. We happened to buy close to the bottom, and then we sold. Maybe it's the top, we don't know, but we sold at a very high price. So when we think about farming, One way to invest in farmland is to buy an actual farm. That could be challenging for people, but if you can find one that's near a city, maybe 2 hours within the city, where people would like to buy recreational property, potentially that is the way to exit the farm and make a big profit. Now, there are crowdfunding platforms that you can use to invest in farmland, and they'll go through all the numbers. An example is AcreTrader. And you need to look at those financials closely, understand how the crops are going to be grown, what the income will be in terms of its generation, and what's the exit strategy. Who are they going to sell the farm to at the end of the holding period? Now, those are more longer-term investments. Another way that I've invested in farm is through a farm real estate investment trust. The one that I own is the Gladstone Land Corporation, and they own mostly berries and nut farms around the country. I bought this particular REIT back in 2018 and then sold it in 2021 after it appreciated 60%, and instead bought the preferred stock of Gladstone that has about a 6% yield. I'll do a video on preferred stocks at some point. But this is a way to invest in a farmland in a very liquid way. You can buy a REIT. Another REIT that invests in farmland is Farmland Partners, Inc. So those are really the 4 ways to invest in farmland. We can buy a farm directly. We can invest through a crowdfunding platform such as AcreTrader, or we can invest in a farmland REIT like Gladstone or Farmland Partners. On the Money for the Rest of Us website, there is a guide on how to invest in farmland. It goes through a lot of the principles that we've talked about. There's some links that you can check out, AcreTrader and those other REITs. This is the comprehensive guide on investing in farmland, so please go ahead and check that out. Hopefully you have found this video helpful. Remembering what drives farmland prices are commodities overall, which is a global market, interest rates, which influences farmland, which influences the value of farmland, and ultimately the parcel that is bought. Does it appreciate, perhaps through a higher and better use, selling it to individuals that want some recreational property like I did with our farm in Teton Valley, Idaho? Hey, if you have any questions on this video, comments, please leave them below. Give the video a like, and please subscribe to my channel. Thanks.